एक बारी स्क्रीन शेयर कीजिए और वेबकैम फिर से ऑन कीजिए सर।
सर ठीक है, स्क्रीन शेयर कर दिया मैंने।
ठीक है सर, आप क्लास स्टार्ट कर सकते हैं।
Okay, okay, thank you. Fine. So students, what we'll do today is we'll be looking at a case study again of a bank and how banks deal with different kinds of risk. We will look at the different kinds of risk that banks are facing and how do they tackle the risk. So in a way, indirectly, we'll be going from this case study to the core concepts of market risk, credit risk, operational risk, all the different kinds of risk which are part of our syllabus. Just to give a brief overview of what we have discussed till now, for people who are joining for the first time, I'll briefly tell you what we have discussed till now. We started out with the overview of the subject. I gave you an introduction to this subject of financial risk management, different kinds of risk that organizations are facing. And these include market risk, these include credit risk, and other kinds of risk like compliance risk is also there, forex risk, interest rate risk, liquidity risk. So, from the perspective of any business, large businesses, what kind of issues they need to deal with. That is what this subject is all about. So in the first class, we had discussed, I had given you an introduction to this entire subject of financial risk management. I've even shared these books with you by Christopher Sun, Jorian. So these are there on the group. If you want, you can refer to these books. Otherwise, a lot of online resources are available on this subject. Then we went on to discuss various case studies including LTCM hedge fund. We looked at the case study of Barings Bank, of GameStop and Melvin Capital, and the global subprime mortgage crisis of 2008. And through this entire case study discussion, covering these four different aspects, we have dealt with various kinds of risk which organizations are facing. And if they do not manage them, something similar can happen. Things which happened to LTCM hedge fund, they had to completely go bankrupt. Same thing happened with Barings Bank and GameStop, led to the downfall of a lot of hedge funds. And even the 2008 crisis is a reminder that all the different kinds of risks have to be dealt with very, very carefully from the perspective of different businesses, be it a small business or a large enterprise. Even if you're an entrepreneur starting your own new startup, you will have to be very careful about these various kinds of risk, including market risk, credit risk, interest rate risk, etc., etc. Then we looked at some ways in which risk management is included in trading. If some of you are interested in trading in stock market, this subject will give you insights on how to deal with variety of risk. Because no matter how good your trading system is, how thorough your back testing and forward testing is, if you do not execute risk management, in case of any black swan event, any unlikely scenario, maybe the market crashes a lot in one single day or it rises a lot in one single day, that one instance can make a huge difference to your entire trading portfolio. If you're managing risk properly, you can capitalize on this kind of large movement and make it work favorably for you. On the other hand, if you're completely ignoring these exceptional cases, you will be inviting trouble and ultimately your entire portfolio can go down to zero in one single day. Right. So this is what we had discussed last time, the impact of risk management in trading. Today, as I told you, we'll be looking at banks. We'll look at how banks manage different kinds of risk. Firstly, what are the various kinds of risk that they are facing, and how do they deal with or manage these different kinds of risk on a day-to-day basis. That is what we'll be discussing today. And again, this case study is just to help you get a hang of the concepts. It's giving you a broader perspective on this entire subject called financial risk management. Now, coming to banks. as we know, banks are in this main business. They have a primary business of lending out funds and taking funds on the other hand. They take deposits from the from investors and depositors. They take fixed deposits or recurring deposits, or even deposits in the form of savings accounts and current account. And using these sources of funds, they are ultimately lending these funds to businesses or to people who require these funds for in the form of home loans or car loans or credit card loans or educational loans. So these loans are given out, and whatever is the difference in between, we are all aware, is the profit net interest margin is the main source of income for the banks. This spread, this difference between the return that they are getting on the loans and what they are giving out to the depositors, is this difference is responsible for their entire profitability. Now, may seem to be a very, very simple business, simply taking funds at a lower cost and lending out funds at a higher cost. Seems very simple, but ultimately there are many challenges which are there in the form of market risk, interest rate risk, credit risk, and other kinds of risk which banks face on a day-to-day basis. And if these variety of uncertainties and situations are not managed properly by the banks, ultimately they can go bankrupt. Like what we saw in the case of Barings Bank, the entire bank went completely bankrupt because of the mistake of one rogue trader who was given too much freedom and to go and trade on behalf of the bank. Nobody was monitoring or supervising this trader, and ultimately he led to the downfall of this um, more than 300-year-old bank called Barings Bank. Same thing may happen in the Indian context as well. We saw what is happening with HDFC Bank lately. There's a scam going on, and senior management and director are retiring due to this lack of corporate governance within the bank. And again, it can create a crisis for big established institutions such as HDFC Bank. And you can imagine what can happen to smaller institutions if they are unable to handle these variety of different kinds of risk. Similar situation happened with ICICI Bank as well earlier, if you remember, when Chanda Kochar was the CEO of the bank. That time as well, the bank was undergoing a lot of these issues with respect to corporate governance and with respect to frauds and all these things. And ultimately, it can lead to a lot of negative outcomes for different institutions. So we'll now come to the different kinds of risks that the banks are facing. After we've understood the primary business of the banks is lending out funds at a higher interest compared to the interest they're giving out on the deposits. That's the first primary business. Apart from this, they're also engaged in secondary businesses or tertiary businesses where they're giving different other services, including maybe brokerage services or including check settlement and payment settlement. Various other kinds of services are being provided by the banks. But these only constitute a small fraction of their entire profitability and business. They are giving out cards as well, credit cards, debit cards, and they are charging fee on these different instruments that they are providing. These facilities are chargeable by the bank, but these are constituting only a small fraction of their entire business. The primary business obviously comes from giving out loans. Once we've understood this basic business model of the banks, let's move on to the different kinds of risks that the banks are facing. The primary risk, as you can easily imagine, is the interest rate risk and the credit risk. Like all various institutions and organizations and corporates, banks are also subject to market risk. We keep hearing in the news that mutual fund investments are subject to market risk. Same thing applies for all enterprises which are operating in different segments of the economy. So is it applicable for banks as well? If banks do not take care of market risk, uh, they can face a lot of difficulties in the future. What are the different kinds of market risks now? One of the risks could be a slowdown or recession in the economy. It can come from the domestic economy. This slowdown can also come from uh, international economies or global economies, such as US or China or other big economies. And ultimately, it can have cascading effects on countries like India as well. Apart from the economic risk, you have other kinds of market risk, like the political situations can also cause a panic or havoc, like what is happening right now in the due to this war between US and Israel and Iran. This war is also causing a lot of unexpected outcomes in various economies, including India. You also have other components. One can be like a slowdown in the economy. Other outcomes, other kinds of risk could include interest rate risk or exchange rate risk or inflation risk as well. These variety of risk can impact the profitability of different enterprises, including banks and NBFCs as well. Just to give you an example, if the economy is going through a difficult phase, a recession, that time people will also not be taking so many loans. Similarly, businesses would also be avoiding loans, and that would impact the overall business and profitability of the banks and NBFCs. If, on the other hand, let's say exchange rates change, that again can cause an impact on the balance sheet of the banks. As we know, different banks are holding a lot of foreign exchange reserves, and if foreign exchange exchange rates are moving very very quickly in one or the other either direction, banks can their balance sheets and their foreign exchange reserves can be impacted adversely. Same applies for interest rate risk. If interest rates move up or down in the economy, it can have impact on the banks. Let's say inflation is high in the economy, RBI can increase the interest rates. If growth is slowing down within the economy and inflation is under control, RBI can decide to cut the interest rates as well. Now, these decisions by the RBI or the central bank of any country can have an impact on variety of financial institutions, including banks and NBFCs. Now, my question to you would be, what do you think would happen? What do you think would happen to the profitability of banks if the interest rates are cut in the economy? Let's say the inflation is under control and growth is slowing down. So, to promote growth, RBI, the central bank, decides to slash the or cut the interest rates. What do you think will happen to the profitability of the banks? Are you expecting the profitability to go up or go down? So think for a while. Let me just tell me if you are able to come up with the answer. Fine. I hope you've thought for a while, and let me just tell you what the answer should be. If interest rates are moving up or down in the economy, let's hypothetically assume that the interest rates are going down. Banks will be impacted in two major ways. The first way would be a reduction in their overall net interest margin. The interest rates on the loans would also go down, and the interest rates on the deposits would also go down. Generally, the fall in the interest rates in the of the loans is much greater compared to the fall in the interest rates of the deposits, and that leads to a shrinkage of the net interest margin for the banks, and this leads to lower profitability from the bank's perspective. On the other hand, there's also a positive impact that the cut in the interest rates will have. It will boost production in the economy. It will stimulate growth, and businesses, small businesses and large corporates would like to take more and more funds, more debt, more loans from the banks to grow their business, to expand their business. They would like to make use of this low interest rate opportunity to get funds at a lower cost and to expand their operations. Now, this would lead to greater business for the banks. The more and more customers would be taking loans from the banks, and this is having a positive impact. Now, these two kinds of impacts, a fall in the net interest margin and a rise in the overall business, are completely contradictory, and the final outcome would depend on which is offsetting the other. Generally, in the short term, cut in the interest rates in the economy can lead to a negative impact on the banks due to this shrinkage of the net interest margin. However, over the long term period, this is actually a positive development. If the interest rates are cut, then obviously the businesses will take time to grow, but over the next few years, banks are expected to uh, generate more and more business from new customers and from old customers, and that would lead to greater profitability in the long run. So you can divide this into the impact of interest rate in short term and long term. And in the short term, due to this fall in the net interest margin, the overall profitability of the banks would be adversely impacted. However, in the long term period, it would lead to a positive impact in the profitability for the banks. So this is one kind of risk that the banks will have to deal with. Apart from exchange rate risk, apart from the risk of slowdown in the economy, these are all examples of market risk. And as you might have said earlier that we can divide the risk into systematic risk and unsystematic risk. These are all these market risk, interest rate risk, exchange rate risk are all examples of systematic risk, while unsystematic risk are specific to one particular bank or specific to one particular industry. These market risks are generally applicable to all kinds of industries and all kinds of companies across different industries. So as you can think that these systematic risks are quite unpredictable, and it's much more difficult to handle these systematic risk compared to the unsystematic risk. Unsystematic risk can be diversified away if you're taking adequate precautions, you're spreading your eggs across multiple baskets. That unsystematic risk can be reduced to a large extent. However, the systematic risk will still remain in the system. So you cannot completely eliminate this systematic risk at all, but you can take some certain precautions to reduce the impact and be better prepared to handle these systematic risks. Apart from the interest rate risk, exchange rate risk, market risk, banks are also subject to credit risk. Credit risk or credit default risk is the risk that the borrowers may end up defaulting and may not end up repaying the loans that they have taken. They might have taken large amount of debt from the banks, but ultimately they may run away to London or some other place. You've heard stories, you've heard examples like what happened with Vijay Mallya, what happened with Nirav Modi and Mehul Choksi and all. They've all taken large amounts of loans and ultimately they've never repaid it. So this kind of risk is known as credit default risk. Now, banks obviously need to be careful while giving out loans to reduce this impact of credit risk. If they're quite careful and lending the funds very cautiously, by taking into account the credit history of the borrowers, by taking into account their CIBIL scores and the rating by the rating agencies, ultimately this credit risk can be reduced to a large extent. Another way for them to reduce the risk would be to take a collateral. If they are giving out loan worth 1 crore rupees, they can take another property as a collateral if they're giving home loans to a certain client. And this would provide them coverage uh, in case the person defaults. In case the borrower defaults, they can simply sell off, auction the property and recover majority of the funds. Now, if these two things are done, credit risk is reduced to a large extent. But like we've discussed this case study of 2008 crisis, the global subprime crisis. It started with this large outflow from the banks in the form of home loans. They were giving housing loans to each and everyone, and that time the interest rates were low in the US economy. Due to this, people were taking large amounts of loans. Everyone was investing in housing and real estate. Ultimately, when the interest rates started moving up in the economy, that time people started defaulting, and ultimately it led to a huge crash for the banks. And when they went to go and sell the collateral, when the banks went to sell the collateral, there were no buyers remaining in the market, and the value of the property, the housing bubble, had completely crashed. And this led to the downfall of large amount of banks, investment banks, insurance companies, and even governments. So there were large losses for all these different entities, and some of them even went completely bankrupt. And this entire crisis was not only limited to US, it had a cascading impact on other economies like the European countries, like even India and other Asian countries. So despite taking large amount of precautions, there is this credit risk which is always inherent for the banks. Now we'll come to the ways in which they can deal with different kinds of risks later on. Right now, we are just discussing the variety of risks that the banks are facing. So we've discussed market risk, interest rate risk, and credit risk in detail. Let's move to the next kind of risk, which is the operational risk. We know in different entities, different corporates, and even banks, a lot of employees are working. And if these employees are not properly trained, or they end up making mistakes, they end up behaving negligently, it can lead to large losses for the entire enterprise. So due to the lack of training or the lack of proper supervision within the enterprise, there is a scope for human error, and there's also a scope for technical error. Due to now technology is completely integrated into the banking system, majority of the things are happening due to this IT revolution within the banking sector as well. And if the system collapses, if let's say somebody is able to hack into the system, or if they're not taking proper cybersecurity measures, that is also posing a risk factor to the different banks and other financial institutions. And both these things, whether it is human error or a technical flaw or lapse, it can lead to this kind of risk called operational risk for the bank. Over the past few years also, there have been a lot of instances where banks have lost large amount of money in hundreds of crores due to these cyber frauds. And plus, the employees obviously can end up making mistakes either deliberately or due to negligence. Let's come to the next kind of risk, which is reputational risk. The bank's reputation is one of the key factors responsible for the growth of the bank. If the bank is not trustworthy, people will not give them the finance. And if nobody is lending funds or giving funds to the bank in the form of deposits, in the form of fixed deposits or recurring deposits or savings or current account, how will the bank acquire the funds and lend out the funds, which is the primary business of the bank, as we've discussed before? So this trust factor is the primary reason why, which is responsible for the growth of the banks. If there is no trust, then the banks will not be able to procure the funds from the different customers and then lend it to other customers. And there are a lot of instances which can cause damage to the reputation of the banks. Like we can see an example in right now happening with HDFC Bank. Similar thing happened in the past with ICICI Bank. Similar kind of fraud was exposed in Yes Bank. And whenever such a crisis happens in any particular financial institution, it can have a very dangerous implication. People will go and start withdrawing their funds if they hear of any such news of the banking system about to collapse, or if one particular financial institution is about to is undergoing a crisis. People will immediately rush and withdraw the funds. And now it's even simpler due to this technology, single click, and you can take out your entire funds. Now, whenever there is a crisis in any particular bank, people will go and withdraw the funds. This is known as a scenario called run on a bank. It's known as a run on a bank. People will go and run towards the bank and withdraw their funds. And if banks obviously do not keep all the funds readily available with them, they have lent out majority of the funds to the other investors and other clients. And plus, they have also parked some of the funds in the form of various other securities and investments. So how will they be able to meet all this unexpected demand of funds, which is arising from the customers because of a lack of trust in the system? And ultimately, the bank may end up going bankrupt if they are unable to meet the expectations of the borrowers. Right? This entire situation is known as reputational risk, which may arise due to any scam or fraud in the system, or also due to negligence by the employees. It can be due to deliberate action by some of the top management, and it can also be a result of improper corporate governance, which is being followed in the organization. Now, another kind of risk is quite applicable for the banks and is known as compliance risk. Compliance risk is simply the inability of the bank or any financial institution to be able to meet the compliance requirements set by the government or the regulatory bodies. The regulator for the banking sector, we all know, is RBI in India. And if the regulations by RBI are not being followed by any particular financial institution, it can lead to a large amount of penalties, financial penalties for the bank. And they may even be shut down in case there is a large amount of compliance lapses which are being found in the organization. If the bank or if the NBFC or any financial institution is not following the rules which are being set by the RBI, and these rules can be with respect to how they're making their investments, what kind of interest they're charging to their borrowers, and what kind of interest they're giving out to the lenders, if they're keeping proper records or not, and whether they're filing all their statements on time, all their compliance reports should be filed on time, and whether they have set up all kinds of proper corporate governance committees and all in the within the bank. If any of these rules are violated by any particular financial institution, it can lead to huge penalties imposed by RBI or the government on the bank. And ultimately, the bank will incur financial losses and may also be shut down in case of a major compliance issue found if it is found in the bank. Now we've discussed variety of risk which the banks are subject to at all times. This is not the exhaustive list. There are multiple other kinds of risk as well. Some of them may be the risk, the liquidity risk, if the banks are unable to meet their short-term liabilities, or it can be a solvency risk if the banks are unable to meet their long-term obligations. It can be other kinds of risk also which the banks are facing on a day-to-day basis. And same, this case study can be extended to other sectors apart from banking, even sectors like pharmaceuticals, FMCG, IT, or housing, real estate. Any sector will be subject to lot of these variety of risk, because there are some borrowers or suppliers or customers which are posing threat risk to the organizations and the enterprises. There are some market risk factors which will always remain in the form of this interest rate fluctuations, in the form of inflation, in the form of GDP growth rate fluctuations and all. Similarly, there will be employees which will be hired by different organizations in all sectors, and which will pose a operational risk. There will be technology which will be applied in different sectors, and that will also pose a operational risk to variety of organizations operating across different industries. There is a reputation which all organizations have to protect. If they're not managing their overall PR properly, public relations, and their marketing properly, it can lead to loss of trust and loss of business for that organization. And all of the organizations operating across different sectors in the economy have to abide by the rules, have to meet their compliance requirements set by the government or by their different regulators. For the insurance sector, it is the rules set by IRDA have to be followed. For the capital markets or brokers, the rules set by SEBI need to be followed. For banks and NBFCs, the rules set by RBI have to be followed, and obviously government is there to supervise. If any of the rules are being violated, then the governments or the regulators will step in and impose heavy financial penalties on that particular entity. So don't take this case study only from the perspective of the banks. It's equally applicable across the board, across different sectors and industries within the economy, no matter which sector you're considering. So now we are done with the basic uh, kinds of risk that the banks are facing. Let's move on to dealing with risk. The other aspect, the more important aspect, once you've identified the different sources of risk, is how do you manage, analyze, and deal with different kinds of risk. That is what we'll be discussing today. Now take a short break for 5 minutes, then we'll continue with the second half, which is dealing with risk. Right. I hope you're learning something new. And let's now continue with the second half, which is how to deal with risk. Once we've identified the different risk sources for our particular enterprise, obviously, this is from the perspective of the enterprises, whether it is across any sector. Then, once you've identified different sources of risk, you will have to analyze and try to deal or mitigate or reduce the impact of these different risk factors, be it market risk, be it the credit risk, or other kinds of risk, including operational, reputational, liquidity, and other variety of risk. So the first thing that we are looking at today is VAR. And before this, before let me just tell you one more thing. Then we'll move to this other concepts which I have, which you can see here on the slide. Okay. So to deal with risk, there are four main methods in which risk can be dealt with. One of the method would be risk avoidance. That is the first method. where we completely avoid risk at all cost. If we think that driving is risky, we do not take our car. We simply take the metro or some other mode of transportation. That is an example of risk avoidance. The second method would be risk retention, where if nothing can be done, this is on the other extreme of the spectrum. If nothing can be done about the risk, you retain the risk with yourself and maybe prepare yourself to handle the impact or the cost of that risk. Let's say that you believe that driving is required and there is no other way that you can uh, commute to college or to your office. You will have to drive, so you will be prepared for certain damages and maybe maintain a small contingency fund in case there is some damage to your vehicle. You will be having a corpus of around, let's say, 20, 30, 40,000 extra, which will be useful to meet any contingency. So building an emergency reserve or building a contingency fund is an example of risk retention. Another method could be risk reduction, which is somewhere in the middle of both of them. Where we cannot completely avoid risk, so we can either retain it or we can try to reduce the impact of that risk. By taking adequate precaution, we can reduce the probability that the event might happen. So driving very, very carefully, cautiously, with your seatbelt on, with taking adequate precautions, not drinking and driving are all examples of reducing risk. Or maybe getting your car serviced regularly is an example of risk reduction. And the last method would be risk transfer, where you transfer the risk to some other party. An example of this would be taking an insurance. If you cannot avoid the risk completely, or you've already taken all the precautions to reduce the risk. You've also built a contingency fund. Another method would be to take a insurance policy or transfer the risk to some other party. This risk transfer can also be done in the form of a derivatives contract that you are doing. That is also an example where you are transferring your risk to another party. If you are buying options, you're transferring the risk to the option seller. By paying a small premium, you're transferring the risk. This is also an example of risk transfer. Similarly, taking an insurance policy is also an example of risk transfer. Uh, Going into a swap agreement with a bank or a financial institution is also an example of risk transfer, where you're transferring the interest rate risk or the foreign exchange risk to the financial institution by again paying a small fee for that risk transfer. So broadly, these are the four ways in which risk can be dealt with. Either avoid the risk completely or try and take adequate precautions, which is known as risk reduction, or transfer the risk to some other party in the form of an insurance or a derivatives contract. Or finally, if nothing can be done, you retain the risk with yourself by building a contingency fund. These are some broad ways that you need to know and remember in which risk can be dealt with. But coming to the specific ways, these are broad ways. Now, coming to the specific methods in which we can measure, identify, and evaluate and prepare ourselves in a better way for these variety of different risks. One measure would be value at risk. This we've discussed in one of our earlier classes. Value at risk tells us, it assigns a probability that given a certain degree of confidence, we are saying, given a 95% confidence or 99% degree of confidence, we are saying that the losses will not exceed a certain amount. This concept is known as VAR, and value at risk, where you are assigning a probability with a certain degree of confidence. You are saying, by looking at previous historical data, you are coming up with the conclusion that in one single day, the loss on our portfolio cannot be more than 5%. or given a 95% confidence, you're saying that the loss on the portfolio will not exceed more than 7 or 8%. This kind of figure that you are coming up with by after looking at historical figures is known as value at risk. And again, it helps us be better prepared for what is about to happen. If we know that in 99% of the scenarios, the loss on our trading portfolio will not exceed more than 10%, we will be prepared for such a scenario. Same applies for different enterprises. If you know that in a single month, usually looking at historical data, in 99% probability situations, the loss will not exceed a certain level. You will be prepared and you will maintain a proper contingency fund to prepare for such a situation. This is known as value at risk. And just a reminder that numericals can also come from this part. You need to be prepared. I've already shared a Word document with you, which has some examples of the numericals. So have a look at the numericals, and these can come in your final exam. Usually there is at least one numerical in your final exam on calculating the value at risk or on calculating beta, and we'll come to these different measures later on. We've already discussed, we've had a class. If you've not been attending the earlier classes, you can go and look at the earlier videos which are recorded. And there you will be able to find the calculations for VAR, how to calculate value at risk. Another method that can be used to deal with risk is known as stress testing. Stress testing, as the name is suggesting, very, very easily you can understand that you are preparing for your various stressful scenarios. You're testing your ability to handle different stressful scenarios from a enterprise perspective. You know that variety of different situations, difficult situations can come, and you are preempting in advance. You are preempting what can happen, what are the worst possible scenarios, and preparing yourselves for to handle those kind of scenarios. Let's say if you're a bank and you know that what is the worst that can happen to us. Maybe everyone, all the, let's say 10% of the people, of the depositors, immediately start withdrawing the funds. How do you handle such a scenario? Or let's say um, suddenly there is a loss of trust, the top management starts resigning. What will you do? How will you handle such a scenario? How will you do your marketing and your PR and your advertising to handle this loss of trust or reputation for the enterprise? Or if some employees start making a lot of errors, how do you prepare yourself to handle such kind of stressful scenario? This is known as stress testing, looking at the worst possible scenarios and preparing yourself in advance. The third term that is there is known as scenario analysis. In stress testing, we are only looking at the stressful scenarios, while in scenario analysis, we're looking at variety of scenarios, maybe a worst case scenario and also a best case scenario, and in the middle, a neutral scenario as well. And you're assigning different probabilities to various kind of scenarios. You know that the worst case scenario is likely to happen maybe in 5% of the situations, and there's a 5% probability attached to the best case scenario as well. And you know that in majority of the cases you will have a neutral scenario, so you will be prepared accordingly. You will be prepared since you've looked at the probabilities attached with various scenarios and also the expected outcome. You know the probabilities that this worst case scenario is likely to happen only in 5% of the situation, and you also know that what is the expected loss in that particular case. Similarly, for the best case scenario, you know that there is a 5 or 10% probability attached to it, and you know what is the expected outcome, what is your expected profit in that particular best case scenario. And you also know the neutral scenario. Now, based on this data, based on this probability and the expected outcome, you can calculate what is your overall expected return, what is your overall risk for the different situations, and prepare accordingly. This is known as scenario analysis. Looking at all kinds of scenarios, assigning probabilities, looking at their expected outcomes, and coming up with the final analysis and preparing yourself for the final outcome. The fourth term given here on the slide is known as sensitivity analysis. Sensitivity analysis is telling you the sensitivity of your final outcome to different assumptions. If we are preparing for the future, we are not fortune tellers, we are not astrologers, so nobody knows with certainty what is likely to happen. But obviously, we can take different assumptions to prepare for different kinds of scenarios. And if you've taken variety of assumptions, whether it is an assumption with respect to the growth rate going forward, growth rate in sales or the growth rate in profitability, or whether it is an assumption with respect to the discount rate, which is telling you about the risk in this in your calculation. So the assumption with respect to the growth rate or the discount rate or any other thing can be helpful. This assumption can help you forecast what is likely to happen in the future. And these assumptions are usually used when you're doing valuation of any particular enterprise or company. These kind of assumptions are also used when you're doing your capital budgeting, when you're doing net present value approach, or you're using internal rate of return IRR approach. Variety of these different assumptions are being used. Now, sensitivity analysis will take into account a range of different assumptions of each of the assumptions and how the final outcome will change if any one of the assumptions is changed. So you make a matrix, sort of a matrix, where different assumptions, if they are changed, let's say the growth rate changes from 12% to 13% or to 14%, or maybe 11 or 10%. So you take these different five scenarios and look at the final outcome based on this changing assumption. Similarly, if the discount rate changes, given a specific growth rate, if the discount rate changes, what impact will be there on the final outcome? So this kind of table or matrix that you're preparing, where you're changing the assumptions one by one and studying the impact on the final outcome, is known as sensitivity analysis. Sensitivity of the final assumption of the final outcome on the various assumptions. That is what we are doing in sensitivity analysis. Other few terms are also important. All of these terms, whether it is VAR, value at risk, whether it is stress testing, scenario analysis, sensitivity analysis, or the other terms are important from your short notes perspective. You can get a short notes question on in your final exam. It's also important from your this case study based questions perspective. If you get a case study in your final exam, you can be asked any of these different concepts. So hedging is one more term we need to know. If we know that we will be impacted by fluctuations in commodity prices, if crude oil is an input in our particular industry or in our particular company, we know that the crude oil prices can impact our profitability. Similarly, if we know that we are an IT company, we're exporting to other enterprises, other countries, our IT services, we will be impacted by a change in the foreign exchange rate. So you can prepare yourselves in advance. If there is going to be an appreciation of the rupee, that will impact the profitability of firms like TCS and Infosys and other IT companies and pharmaceutical companies which are exporting to US. If the rupee will appreciate against the dollar, that will lead to losses for these enterprises. So what they can do is they can short the USD INR forward contract. They can go short in the futures or the forward contract of USD INR, or they can buy a put option on USD INR, or they can sell a call option. Depending on various on your entire analysis, you can use various tools to protect yourself against the changing environment. In advance, you can prepare yourself. Similarly, if let's say crude oil is an input in your company, and you're scared that this Iran-Israel war can lead to spike in crude oil prices, how you can prepare yourself is very simple. Simply buy a futures contract of crude oil, or buy a call option, or probably sell a put option on crude oil. And this will protect yourself, this will protect your enterprise against fluctuations in the crude oil prices. So ultimately, if you are using these derivative contracts, it's an example of all of these are examples of hedging, which is reducing your risk going forward. So hedging can be done. And even from a bank's perspective, they can hedge, they can spread their risk across multiple different industries and sectors. Instead of lending all their funds to one particular enterprise, maybe Ambani's or Adani's, they can spread it across different 500 or 1000 different firms. They can give loans to different enterprises. This is an example of diversification. Diversification can be helpful again for reducing the risk. If you're spreading your risk across your allocating your funds across different basket, then your risk is being diversified and reduced to a large extent. And diversification is applicable across the board, across different sectors, whether it is an enterprise in any sector, whether it is a banking company or NBFC or any other company. You can diversify your risk by having a range of suppliers, having a range of buyers, and not depending completely on one particular supplier or one particular buyer. Insurance or risk transfer. This is one more method to deal with risk. Very simple way. Simply pay a small premium, pay a small fee to the insurance company, and your risk will be taken care of by that other enterprise. They have also done their calculations. These insurance companies are not doing social service, they're not running NGOs. They have done all the calculations looking at historical probabilities of various events. They know that what is the expected loss and what is the expected probability of the loss, and using these two different variables, they can come up with the premium they need to charge for giving you this coverage, risk coverage. But ultimately, it can protect the enterprises against large losses if such a situation actually happens. The last term here is Monte Carlo simulation. Monte Carlo simulation is an exercise performed using technology, using various tools, and it is helpful in conducting variety of different simulations. You are taking thousands of different simulations. You're simulating various scenarios, thousands of different scenarios, and analyzing the output. The software will obviously do the entire job. It will take variety of different scenarios, thousands of different scenarios will be considered, and the expected outcomes for each of the scenarios will be given to you. Based on this different scenario analysis done by through the Monte Carlo simulations, thousands of simulations, you get an idea of what is likely to happen and can be better prepared to handle variety of scenarios. Right. So we've looked at banking sector. Today we've been looking at the variety of risks that the banks are facing, and we've looked at how generally risk can be dealt with, including tools like value at risk, including tools like stress testing, scenario analysis, sensitivity analysis, hedging, diversification, risk transfer, Monte Carlo simulations. All of these are terms which are important from your exam perspective, and also in your if you're working in a job in any enterprise as a risk management professional, you should be aware of all these different tools which can be used to manage or handle variety of different risks. So now what we'll do is we'll come to risk management specifically for banks. And since we've discussed variety of risk, we will go back to these risks and try and see how banks manage each of these different categories of risk. And this will give you insights of how different enterprises, not only banks, enterprises in various sectors of the economy can handle different kinds of risk Obviously, this will vary little bit slightly across different sectors. The risks that are being faced by the pharma companies are little different from the risk being faced by financial companies. But still, this will give you some idea of how different enterprises operating across different industries can manage all these different kinds of risk. And if you've missed the lecture or you're joining late, you can go back to the recording, look at what was discussed in the first half, and then proceed with this second half of the recording. Take a short break. We've covered the second part, general aspects of dealing with risk, and now we'll come to the third part of today's class, which is the management of risk or dealing with risk in the banking sector. We'll continue after a short 2-minute break. कर रहा हूं मैं Let's look at each of these risks and how banks are managing all these different kinds of risks that they are facing. Let's start with market risk. Like I told you, market risk cannot be completely eliminated. It will always remain in the system. Trump will keep doing all these silly things and unpredictable things all the time. Similarly, Modi ji will be coming up with different new announcements. RBI, central banks will also keep on changing the interest rates. And all of these things uh, will pose a risk factor for the banks. Now, to be better prepared, they can. One way to deal with market risk would be to, if you're talking about foreign exchange risk, you can either keep limited reserves or hedge them using derivatives. So derivatives can be used to tackle the foreign exchange risk. Just like IT companies have to hedge or protect themselves against the foreign exchange risk, similarly, the banks also have to protect themselves. They will be using derivative contracts like futures, forwards, swaps, options uh, to reduce the risk to a large extent. If they believe that USD INR is about to go down, they can go short in the futures contract, or they can buy a put option like I told you, and this will reduce their risk on the foreign exchange reserves that they are having. Similarly, if you are dealing with interest rate risk, you can go with interest rate swaps. They can participate in interest rate swaps, where you are engaging with other entities, other banks, and if let's say you believe that the interest rates are about to go down, you can exchange your fixed with floating and floating with fixed across different parties. So one bank may believe that the interest rates are about to go up, other one may believe that the interest rates are going to go down, and ultimately both of them can uh, exchange their liabilities and their assets in the form of this fixed to floating swap or floating to fixed swap, and ultimately reduce their overall interest rate risk. This is one way to deal with this risk. Apart from this interest rate risk, they can do a lot of forecasting. Forecasting can be done using regression and other time series analysis. Nowadays, softwares are available for forecasting. Forecasting can be helpful even if you're talking about forex risk. Foreign exchange rates can fluctuate, and forecasting can help with this. Similarly, forecasting is actually applicable across the board, especially with even with credit risk and other things. So if you know historically what the risk has been, you can use that historical data to forecast what is likely to happen in the future. Market risk obviously cannot be completely eliminated. If it cannot be completely eliminated, one way could be to keep sufficient contingency reserves. So risk retention is one way. Risk retention using contingency reserves, and also performing stress testing or scenario analysis or sensitivity analysis can help with market risk. And even value at risk can be helpful. Monte Carlo simulations can be used. And these general methods that we have been discussing till now are useful across the board, whether it is market risk, interest rate risk, foreign exchange risk, credit risk. These kind of um, risk factors can be analyzed in a much better way, and preparations can be done accordingly using all these different tools that we've been discussing till now. Then credit risk, to deal with credit risk, there are credit derivatives also available. Credit default swaps are available. Credit derivatives or credit default swap, CDS, can be used where you're swapping your credit default risk with another party. You're transferring your risk to another, maybe insurance company, and by going through these instruments called credit default swaps or credit derivatives, which are known as. Plus, you can reduce the risk by evaluation of borrowers capability and balance sheet. So evaluation, proper due diligence can also be helpful in reducing this credit risk, and taking sufficient collaterals while giving out loans can be helpful to recover the losses in case the credit default is happening. Thus, again, forecasting and all can be helpful. And even nowadays, AI tools are available for early detection, and risk reduction. So there are tools nowadays available for in the banking sector for different banks and NBFCs which will help them detect where the credit default is about to happen or more likely to happen, and so they can take adequate precautions and prepare themselves in a better way. These AI tools will also be helpful for managing operational risk if to detect for fraud detection and risk reduction. Plus, training of employees will help reduce this operational risk, and taking adequate cyber security measures will be helpful. And even applying proper corporate governance standards across the organization will be helpful in tackling the operational risk. Let's now come to reputational risk. Here, um, this stress testing can be done. PR and marketing exercise can be helpful for trust building. For compliance risk, mhm, for managing compliance risk, the banks can hire specialized compliance mm, employees. So compliance experts can be used um, who are keeping track. They can build a team uh, to take care of all the compliance requirements. This team will also um, keep themselves updated at regular intervals because regulations keep on changing. The regulators and the government will keep on changing the rules. So these rules have to be detected whenever there is a change. The change in the rules has to be detected very early, and then corrective measures have to be taken accordingly. Even softwares and AI tools can help with managing compliance requirements. So many documents have to be filed on a regular basis periodically by these banks. The banking sector is subject to large amount of regulations because they're dealing with so much funds, and to to file all these cumbersome documents is not so easy, and technology can be useful in meeting all the compliance requirements. So this is just to tell you what different ways the banks can use to manage variety of risk. And similarly, variety of other organizations operating across different industries and sectors can use some of these techniques and maybe modify some others to reduce their different kinds of risk. And market risk, you can even use diversification and hedging for protection. Right. Now just I'll summarize the entire discussion in 1 or 2 minutes. I'll try and summarize the entire discussion so that you know whatever we have discussed, and you have a summary of the entire conversation of the entire session. The We started out with the discussion on risk management in case of banking sector, where looked at the sources of different risk, the types of different risks that the banks are facing, and then we went on to discuss the various methods which can be used for reducing the risk. And finally, we integrated both the things to look at risk management in case of banks. If they're dealing with market risk, which can be due to the fluctuations in GDP growth or in the fluctuation in interest rates and foreign exchange rates, this can be dealt with using variety of techniques, including stress testing, scenario analysis, sensitivity analysis, value at risk, or Monte Carlo simulations, diversification, hedging, and just keep in mind that this risk cannot be completely eliminated. So you need to have proper contingency reserves to be prepared for these worst case scenarios, to be prepared for these black swan events, which may happen. These kind of situations always happen once in a decade or maybe even earlier. That's the reason contingency funds and emergency reserves have to be maintained to retain if you have to retain the risk and cannot completely eliminate market risk. To deal with interest rate risk, again, derivatives can be used, interest rate swaps can be done, and forecasting can be done using technology and software to predict what is likely to happen in the future and prepare yourselves accordingly. Same thing can be applicable for foreign exchange risk. To deal with forex risk, forecasting can be helpful, and derivatives can be useful to deal with forex risk. Credit risk is one of the major sources of risk that the banks are facing. And to handle this risk, they use either credit derivatives like credit default swaps, where the risk is swapped with some other party, transferred to some other party. And this, apart from these instruments, for proper due diligence should be performed while giving out loans. Borrowers' proper repayment capability needs to be checked. Their CIBIL scores and credit ratings need to be analyzed. Their balance sheets have to be looked at carefully. Job of accountants, and ultimately, then the loan should be given to the qualified borrowers. AI tools can help with early detection of patterns and preparing accordingly. Operational risk can be managed with the help of proper training of employees, taking adequate cybersecurity measures, and applying the corporate governance principles and standards across the entire organization. Whether it is having independent board of directors, whether it is having a proper board of trustees, or it is having different risk management committees within the organization, are all measures which can be helpful in handling or tackling the operational risk, which is the risk being posed by employees or technology. um, and then AI tools again are helpful for early fraud detection and risk reduction. Nowadays, it's so difficult given the scale of these large organizations to detect everything manually. So you need advanced softwares and technology, and AI can be helpful in detection of frauds and reducing the risk. For managing reputational risk, since we know that trust is one of the important, single most important pillars in the banking sector, they have to manage the trust factor very carefully. PR and marketing exercises can be helpful for trust building. Along with this, stress testing can be done to look at all these different adverse scenarios which can happen within the bank, leading to loss of trust, and then banks can manage accordingly. Compliance risk, which is the risk of inability to keep pace with new compliance requirements, is another risk, and this can lead to large financial penalties and fee for the banks and different organizations. So to deal with this compliance risk, you have to keep yourselves updated with the new regulations in this sector. And then softwares and tools can help you with managing all these cumbersome compliance requirements. They require large amount of time and resources. So if you use proper technology, all these documents can be filed in a more systematic manner, in a much more organized and effective way, instead of doing it manually, which is more time consuming, requires large amount of labor and resources, and may not be the most efficient way to keep yourselves updated with all the newest compliance requirements, and then finally filing all the requirements, all the documents on time. So this uh, session that we had today, this discussion should be helpful for you in learning how banks deal with different kinds of risk, what are the different kinds of risks that they're facing, and will also give you insights to risk management across uh, various sectors within the economy, not only the banking sector. These rules and risk factors are applicable across the board, whether it is a pharmaceutical company, an IT company, a real estate company, or even if it's a large enterprise or a small, medium size or micro sized enterprise, whether it is a new startup or an established mature firm. These kind of risk factors are there across the boards. Obviously, as a new enterprise, you need to be much more careful, and as a large enterprise, you will have more resources at your disposal to be able to take care of these different kinds of risk factors. But ultimately, if these things are not considered or not dealt with carefully, it can lead to uh, unexpected situations and can cause losses for the entire firm. So that's it from my side for this class. In the next class that we have next week on Saturday, we'll be looking at other case studies. We'll take the subject through case studies mainly, and these case studies will help you look at various sectors and industries and how each of them tackle variety of different risks. So we'll be looking at other, last time we looked at how traders and trading and brokerage houses can manage risk. This time we looked at banking sector and NBFCs, how they can deal with different kinds of risk. And then earlier on, we had looked at various hedge funds and the global subprime crisis. All of these are giving you uh, valuable information on the importance of risk management and financial risk management across um, all sizes, types of companies. And once we are done with a few more case studies, then finally we'll move on to the concept of enterprise risk management. What is enterprise risk management? It is becoming more and more popular these days. You even have dedicated courses on enterprise risk management. This is one topic that we'll be looking at in the coming classes, apart from various other case studies, which will give you, which will also keep things more practically applicable, more interesting. And then finally, we look at enterprise risk management um, to, um, to summarize the entire discussion. So I hope more people will be joining next time. And if you have any more doubts, anything that you would like to discuss in more detail, let me know so that we'll take up those topics which you find more interesting, which you believe would be more useful for you from your exam perspective and also from your daily life point of view. Uh, I want these discussions to be applicable not only for your exam but also in your day-to-day lives. If you're able to apply some of the knowledge, that I think would be a much more superior objective apart from clearing the exams. Right? We'll meet on next Saturday now, same time, and see you guys over there. That's it. Thank you.
Okay, sir. Good night.